Hello everyone, welcome to TP Talks, PwC's Global Transfer Pricing podcast series, where professionals share their perspective on key transfer pricing developments. Today we will be discussing Swiss tax reform and what it means from a transfer pricing perspective. My name is Dana Hart, and joining me today from our Zurich office, I have Benjamin Koch, our Swiss transfer pricing leader. I also have Armin Marty, our Swiss tax policy leader, and Flora Marin, a transfer pricing senior manager, who will also be our moderator for this podcast today. Flora, I'm going to go ahead and hand it over to you to get our discussion started.
Thank you, Dana, for inviting us today. We're currently living a historical moment in Switzerland as the Swiss tax reform was approved by 66% of the Swiss voters on May 19th. With this vote, Switzerland has agreed to abolish the current tax regimes for holding companies, domiciliary companies, and mixed companies. There will still be some cantonal votes until the end of the year. However, the new tax measures shall be implemented as of 2020 and will ensure that Switzerland meets the OECD and EU requirements, removing Switzerland from the EU's grey list. So what does it mean for international companies? International companies will be subject to an effective tax rate in the future of around 12 to 14%, which is an increase from rates under the current regimes, roughly around 8 to 11%. However, domestic companies should experience a tax rate reduction. To smoothen the transition, Switzerland has enacted various transitional measures to help taxpayers move gradually into the new tax system. In addition, Switzerland will implement a patent box regime as well as an R&D incentive scheme to remain an attractive place for all high-tech and innovative companies. With these new measures, Swiss and international companies will benefit from very competitive tax rates that may go down to 9 or 10% effective tax rate. Let's now dive into some of the details to better understand the key implications of the Swiss tax reform for multinational companies. Armin, with the abolition of current tax regimes effective January 1st, 2020, what should we know about the transitional measures once the current tax regimes have been abolished?
Yes, Flora. As you mentioned, the abolition of current cantonal tax regimes becomes effective from January 1st, 2020. For companies benefiting from a current regime, this would in principle mean that they will become subject to ordinary cantonal taxation as from 2020. However, to smoothen the transition into the new tax system and to avoid a fiscal shock, there are generally two options available during a transition period. Option 1 is the step-up model with amortization. Option 2 is the separate rate model. Let me start with the first option, the step-up model with amortization. Generally, this involves a tax-neutral step-up of assets and goodwill to fair market value in the tax balance sheet to the extent the hidden reserves and goodwill were previously tax-exempt under a current regime. The stepped-up assets in the tax balance sheet can then be amortized tax-effectively. Depending on the canton, such tax-effective amortization is generally available for a period of maximum 10 years. As a result, the effective cash tax burden is reduced to a similar low level as today. This option is available in most of the Swiss cantons based on current law practice. It is, however, not available in some of the French-speaking cantons, and some cantons restrict the tax amortization period to 5 years. The second option, the separate rate model, generally subjects the same amount of hidden reserves and goodwill created during the application of the current tax regime to a separate lower tax rate. The lower rate is determined by canton and can vary quite a bit from one canton to another. The advantage of this option is, however, that it has no impact on deferred taxes at group level. The disadvantage, on the other hand, is that it is only applicable during maximum 5-year period.
Thank you, Armin. Benjamin, there are two key measures in the Swiss tax reform, the patent box and the R&D incentive, or the super deduction, that may impact existing structures or impact where a company may decide they might want to locate. Can you talk a little bit about these two measures?
Sure. Thank you, Flora. So the patent box regime, which mandatorily will need to be implemented by all cantons, will provide a base reduction, so not a lower tax rate, on income made from intellectual property rights like patents and royalties on patents. Important in the assessment whether or not the patent box is an attractive regime is also the fact that sales of products with embedded intellectual property will be eligible for the patent box. The regime is available to all companies, independent of size and industry, that have patents or equivalent rights like licenses, and that have R&D expenses in Switzerland. In this respect, it is important to mention that Switzerland's patent box regime is following the OECD BEPS guidance on harmful tax practices, particularly on the nexus approach, so local R&D expenditures are important, or that the marketing intangibles which are not part of the patent box. The R&D superdeduction, which cantons can implement on a voluntary basis, is an incentive allowing a deduction of an additional 50% of R&D expenditures, defined as personal expenses, but with an uplift of 35% to cover R&D related costs.
Thank you, Benjamin. Given the short period of time before Switzerland moves to the new tax regime, I want to ask both of you to provide your recommendations on what companies should be doing before the end of 2019. Armin, why don't you start?
Yes, Flora, as you have heard, as part of the Swiss corporate tax reform, corporate income tax rates will decrease in many cantons. Furthermore, there are new measures available and options to transition into the new system. Obviously, a Swiss company must not do anything to benefit from the reduced cantonal income tax rates. This will come automatically, and the effective tax rate will be between 12 and 14% in most places. However, in a few cantons, the effective tax rate can be 6 to 10% higher, i.e. above 20%. Given these differences in effective tax rate, a company may hence want to review where within Switzerland it wants to be located mid to long term. Concerning all the new measures which will be introduced, a Swiss company must become active, as these measures require the taxpayer to make certain applications. Regime companies must first choose between the two different transitional options which are available in most cantons, the tax balance sheet step-up model or the separate rate model. Whilst the cash tax effect of both options is generally similar, the two options differ regarding the period during which they are available, 5 versus 10 years, and regarding their impact on deferred taxes. One has impact, the other has not. As regards the level of hidden reserves and goodwill available for the step-up or the separate rate model, fair market valuation must be performed and pre-agreed with the Swiss tax authorities. Obviously, also companies that want to benefit from the other measures must become active. This means that they must assess whether they qualify for obtaining relief from the patent box, the R&D superdeduction, or the notional interest deduction. The latter, the notional interest deduction, is available in the canton of Zurich only. The impact of these measures, including the interplay with each other, is complex and must be carefully assessed. In many cases, we recommend to pre-discuss them with the Swiss tax authorities. An important question is also the timing, as from when on the effects of the Swiss reform must be reflected in the group accounts. Here the rule is that the effects must be fully reflected in the group account as soon as the new rules have been enacted. The enactment date is typically determined by the time the cantons have implemented the provisions of the Federal Harmonization Framework Law into their cantonal tax laws. Such date differs from canton to canton. 5 cantons have already passed the necessary procedures, including cantonal votes. These are Vaud regarding tax rates only, Basel City, Neuchâtel, St. Gallen, Glarus, and Geneva. Other cantons will follow later this year. Whilst in Zurich, for example, the popular vote is to be held in September, in a number of other cantons, their cantonal popular referendum will be taking place in November only.
Thank you, Armin. What about you, Benjamin? What are clients currently doing in Switzerland to assess the new situation?
Yeah, to give it a little bit of structure, I would say there are 4 important steps for the patent box. So step number 1 is an assessment of the client's current patent portfolio. This is typically done in a workshop with the client's responsible R&D, controlling and tax people. Typically, we recommend the client to also bring in a patent lawyer to assess the white spots. For example, spots for areas which would be beneficial being patented. Step 2 is an assessment once you have identified the respective patents, which products are covered by those patents and what are the respective financials behind, for example, net revenues, the margins, etc. Step 3 is the modeling, or in other words, a simulation on the taxpayer's facts and circumstances to evaluate the merits of applying a patent box. PwC Switzerland has developed the respective simulation tools, which will provide the taxpayer with an assessment of the financial impact taking advantage of the patent box regime. This provides the client with all the relevant facts to make an informed decision. Step 3 also includes an assessment of the nexus in Switzerland. Just to remind you, this is the question: how much R&D expenses in Switzerland versus R&D expenses in the rest of the world for the patents brought into the patent box. This is not only a healthy exercise from a patent box perspective, but also from a transfer pricing perspective by reviewing the value chain of research and development with respect to DEMPI functions and R&D costs. Step 4 includes the implementation of the patent box with the tax authorities, as well as, if I may say so, the maintenance of the patent box, particularly the calculation of the nexus ratio, the budgeting and review of the R&D expenses, etc. In summary, step 1, assessment of patent portfolio. Step 2, match intangibles with revenues and profits. Step 3, prepare a modeling and simulate the outcome. And step 4, implementation and maintenance of the patent box.
Thanks, Benjamin. And what about the R&D tax credit?
The R&D tax credit regime, again, which is only implemented in some cantons, is pretty straightforward. There are 3 steps. Step 1, you need to know your personnel expenses on R&D. I see in practice that there is sometimes an effort required, since those expenses are not presented in the local GAAP accounts in exactly the way you would need it. Step 2, you simulate the impact by adding a 35% uplift on the identified R&D expenses to cover all other R&D related costs, and calculate from there the 50% additional deduction. Step 3, in case the taxpayer would like to implement the regime, you prepare a presentation and discuss it with the tax authorities. The discussion will then also provide you with the next steps and information for the formal implementation.
Many thanks to both of you for these details. So, to summarize, international companies will benefit from an effective tax rate of 12 to 14% as of 2020 on average, with some cantons being higher like Zurich or Bern. In principle, this will mean an increase in effective tax rate for all companies subject to a privileged tax regime today, and a decrease for all companies ordinarily taxed. If you're in a situation where the company is subject to an increase in effective tax rate, first you can apply for transitional measures to extend the period of the tax benefits if the company was subject to a privileged tax regime. Then you can also assess your eligibility to the patent box regime, R&D incentive scheme, or other measures such as the notional interest deduction in Zurich, for instance. If, on the contrary, you're subject to a decrease in the ordinary tax rate, you should also assess whether you could further benefit from the patent box regime or R&D tax credit to further reduce your effective tax rate. As a consequence, Switzerland will remain an attractive location for multinational companies in the future, and companies should start assessing the impact of the Swiss tax reform to better understand the potential of the various measures. With this podcast, we hope that we could share some valuable insight into the Swiss tax reform and interesting planning opportunities. Thank you, Dana, for having us here today.
Thank you, Benjamin, Armin, and Flora, for sharing your insights on Swiss tax reform. I also want to thank our listeners. If you would like more information about this topic, please contact the speakers. You can find their contact information in the description of this episode. Thank you.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.